What if the bond market just made the first move and equities are about to respond? Today we're seeing something very interesting. The 10-year Treasury yield is pushing back above 4.08%. SPY is breaking higher towards 687. QQQ is approaching 607. On the surface, this looks bullish, but here's the question. Are stocks rallying because the economy is strong, or are they rallying despite rising yields? Because historically, when yields move higher, high-growth stocks don't usually celebrate. So let's break this down. Starting with SPY. SPY is trading around 687, up roughly 0.6% on the day. We saw a strong intraday push after the morning dip, and buyers clearly stepped in aggressively around the 682-684 zone. That level continues to act as short-term support. The structure today shows momentum returning after consolidation. However, we're approaching prior resistance near 689-690. This is important. If SPY clears that zone with conviction, we could see continuation toward the 695 area. But if momentum stalls here, this becomes another lower high within a larger consolidation range. Now let's look at QQQ. QQQ is outperforming, up nearly 1%. It reclaimed the 605 to 607 area, which is psychologically important. But here's the nuance. QQQ is more sensitive to yields than SPY, and yields are rising. The 10-year Treasury yield is now back above 4.08%. That move matters. We're sitting in a key macro zone between 4.05% and 4.10%. This area has acted as a pivot over the past few weeks. When yields break above this range and hold, equity volatility tends to increase. Why? Because higher yields mean higher borrowing costs, higher discount rates on future earnings, more pressure on high-valuation tech stocks. Now here's what makes today interesting. Stocks are rallying while yields are climbing. That tells us one of two things. Either the market believes economic strength justifies higher yields, or equity traders are ignoring the bond signal temporarily. And historically, the bond market tends to lead. Today's macro environment remains driven by inflation expectations, Fed rate outlook, and economic resilience. Recent commentary from policymakers continues to reinforce a higher-for-longer tone. Markets are constantly repricing the probability of rate cuts, and every time yields push higher, it signals that bond traders may be adjusting expectations again. If economic data remains strong, yields can grind higher. If inflation surprises to the upside again, yields can spike, and that's where equity risk increases. So while today feels bullish, the macro backdrop is still fragile. Technically speaking, SPY, support 682, resistance 689-690, above 690, breakout scenario, below 682, back into consolidation. QQQ, support 600-602, resistance 608-610, above 610, momentum continuation, below 600, weakness resumes. And yields, key pivot, 4.05%. Above 4.10%, pressure increases. Back below 4.00%, relief for equities. Right now, we're in tension territory. This is compression, and compression usually resolves with expansion. Here's what I'm watching closely. Does SPY hold above 685 into the close? Does QQQ maintain strength despite higher yields? Does the 10-year yield break and hold above 4.10%? If yields accelerate upward while equities stall, that's your warning signal. If yields stabilize and equities continue climbing, that's risk-on confirmation. But the next decisive move will likely come from the bond market. Always watch the bond market. Right now, the market looks strong. Momentum is there. Buyers are stepping in on dips, But the real story isn't the green candles, it's the yield level quietly climbing in the background. Because if the 10 years starts trending higher from here, equities will eventually have to respond. The market isn't just trading price, it's trading expectations, and expectations are shifting. We're at an inflection point. Stay sharp.